Hey everybody, Mr. Wallowitz here. Hope everybody is doing well. We're going to start to move on from the new era in American history in the early 20th century with the Roaring Twenties and into now one of the darkest times in American history. With conservative economic policies in place for much of the 1920s, the American economy was headed for collapse. Here we will see the origins and the reasons for the Great Depression. Origins of the Great Depression. On Thursday, October 24, 1929, stock market prices started to crash. Panic selling set in and stock values sank to sudden lows. Leading bankers met to raise funds to temporarily save the market. It was like the leading heads of these banks, who were extraordinarily rich, pooled their money together to help save the market. And on the Friday the 25th, they were able to at least save it from complete collapse. But as fear spread over the weekend, more and more investors sold stock. And by Tuesday, October 29, 1929, known as Black Tuesday, the stock market crashed. Stock market crash alone, however, did not depress the economy. It did expose a number of factors that led to the greatest economic crisis in American history. And some of these factors that we're going to be looking at in the next couple of slides here is rising inequality, declining demand, rural collapse, overextended investors, and the bursting of the speculative bubbles. First, we have rising inequality. The gap between the rich and poor accelerated in the early 20th century. Per capita income had risen 10% for all Americans, but 75% for the nation's wealthiest. Conservative policies of the 1920s exposed this divide. With low corporate and personal taxes, easy credit, and depressed interest rates favored the wealthy. Declining demand. Pro-business policies of the 1920s saturated the market with durable goods. These durable goods meaning like goods produced in the United States or brought to the United States, imported to the United States, would last a very long time. More and more well-to-do, the upper class, had no need to buy cars, radios, and other goods that fuel economic growth. The supply of certain product, too, drives down the price. As you have an abundance of product, you need to sell as much as you can to replace that product, so the price of the product goes down. And, when products failed to sell, companies had to lay off workers. Advancements in technology in the workplace led to overproduction. With prices going down, many plants and factories had to close. As more and more factory workers entered unemployment, growth and job opportunities could not keep up. And with an abundance of factory workers heading into unemployment, it stripped potential consumers of cash. And a lot of people were not now able to spend money to stimulate the economy. Rural decline. The Great Depression has its roots in the farming sector as well. Advancements of fertilizers, mechanization, and improved seed led to overproduction of crops. And because supply was high, costs were low. As the price of agricultural products were falling, many farmers couldn't sell enough product to pay their bills. When you have an abundance, as we said with factory workers and the factories, when you have an abundance of supply, the cost of that supply goes down to sell it, to replace it with the new harvest. Farmers couldn't sell enough to pay off their bills, and bills like utilities or equipment loans that they had, mortgages, especially on their land. So farmers began to go out of business. And this causes rural banks to close because farmers couldn't repay their loans. Banks can't make money off of those loans if nobody is repaying those loans. The Smoot-Hawley Tariff Act. Economic depression was not uniquely American either. Countries around the world were hit just as hard. So the League of Nations asked that all countries stop the tariff system, stop taxing imports and exports. Because of worldwide debts, the League felt that relying on other sources should replace tariffs, and the only real source at the time was goods. As a way to protect American jobs and farmers, Utah Senator Reed Smoot sought support for a tariff on domestic goods and exports. Many people, including Henry Ford, tried to convince the President Hoover, to veto this act, but to no avail. Other countries, in response to these new tariffs, raised their own tariffs. America's biggest trading partner, Canada, raised tariffs on 30% of their exports to the United States. Tariff increased the import tax 60% on more than 3,200 imports. Because of the tariff, American imports, stuff being imported from other countries, decreased 66% because other countries did not want to trade with the United States. Both Reed Smoot and co-sponsor Willis Hawley of Oregon were defeated in re-election attempts in 1932 because of the failure of the Smoot-Hawley Tariff Act. Speculative bubbles. The last element to the Great Depression was a very human element, panic. Banks started denying loans and called in all debts. People started to withdraw their money from the bank in fear that because banks were denying loans and calling in debts, that the banks were about to fail. So people were hell-bent on trying to get their money out of the banks before the banks closed, and you lost your money. And before the end of the 1920s, in those last couple of months of 1929, just about 744 banks were forced to close. And so finally, the stock market crashes. With a combination of overproductivity, debt from bank loans, and banks closing the stock market began to fall. In September of 1929, the London Stock Exchange crashed and American investors began to doubt foreign investment. The expected passage of that failed Smoot-Hawley Tariff Act scared a lot of investors as well. The week before the stock market crash, trading grew to a very high level with the selling of many stocks, a majority of stocks on the market. Stock market lost about 11% of its value. And then over that weekend, after October 24th, that Thursday, when stock prices suddenly fell, and then bankers, the extraordinarily wealthy men, pooled their money together to try to save the market. Reports are starting to get out now over the weekend of October 26 and 27, 1929, as newspapers began to cover an uneasy stock market. So come Monday, many investors now decided to get out. They're selling all their stock, and that is not good for the stock market. On Tuesday, October 29, again, Black Tuesday, the stock market lost another 12% of its value behind the rumor that Smoot-Hawley Tariff Act would not be vetoed by President Hoover. Investors knew that act was a bad idea, and investors got out of the stock market. President Hoover made some mistakes along the way too by signing that Tariff Act, not listening to a lot of business owners at the time who did oppose the Tariff Act. He made mistakes, and we are going to look into some of those mistakes that he made along the way as well. So thank you for listening. Thank you for watching. Have a great day, and we'll see you soon.